Hi guys, welcome back. You finally decided you're going to make that date. You're going to start investing. What do we do now? What kind of decisions do we have to make? We have to figure out what we want for our mix. We have to figure out our asset allocation. It's the most important thing we have to think about when we invest. Coming up next, Firefighter Financial Toolbox. Hi guys, welcome. So we finally made the decision we're going to start investing. Now we have to decide what we want to invest in, but most importantly, we have to figure out our asset allocation, how much we want to invest in stocks, how much we want to invest in bonds, and if we want to have some cash in there, how much we want to do. It's the biggest decision we make, and it has the biggest impact on how our portfolio will do over time. Now, when I say over time, why is that important? Because remember, we are not investing for this year. We're investing for 30 years or 40 years. We're investing for our whole lifetime. The stock market is not a get-rich-scheme thing. It's a get-rich slowly. We continue to add money, and over time, we can expect 7, 8, 9, 10% gains. Now, that doesn't mean every year is going to be rosy. What do I mean by that? How many of you were investing in 2008? I was, and I know I was pretty aggressive. My stock was about 80-20 then, and I took a 40% hit in my balance. Now, imagine this. You have $100,000 in your account, right? $100,000, and it drops down to 40% less. So now I have $60,000. When it happens to you for real, it is scary, guys. You want to sell. You watch Bloomberg or CNN or any of those, and all the market people sell, sell, sell. They want you to sell. Here's why. The stock market, Wall Street makes money if you buy stuff and if you sell stuff. If you leave it alone, they don't make any money. Remember, even if it's scary, we have to be able to hold on. So when we make our decision on our asset allocation, we have to be honest with ourselves and say, can I sleep at night if my account is losing 40%? If the answer is yes, then maybe you can be 100% stocks. If you're younger and you have a longer time horizon, more aggressive is better. But if you're somebody who is going to freak out and go, oh my gosh, I lost $10,000 this week, and sell when you're down, you're going to lose a lot of money in the long run, guys. And it's easy to do. We all tell ourselves, I would never do that. I can tell you, I came pretty close. When you watch your balance go down by $60,000 or $40,000, it is scary. It's real. But here's the thing I learned. It's not a real loss. I had $100,000. I lost $40,000. As long as I keep investing and I keep going in the market, it's going to come back. It always has. Traditionally, over history, it's always come back. There have been ups and downs, and there will be more ups and downs. There will be market declines. It may last for years, but we have to think the long approach. Since the bottom of 2008, my stocks are up almost 300% now. Yes, it took 10 years for it to recover to this point, but it did, because I didn't sell. In fact, what I did by not selling is buying my stocks cheaper. Today we're talking asset allocation. So we have to decide what percentage we want to have in stocks, what percentage we want to have in bonds, and what percentage, if we want, in cash to have in our account. This is a decision that fundamentally leads how well your portfolio will do. The more you have in stocks, the more aggressive, the more up and downs you're going to have in your portfolio. But also, because you're taking more risk, you have the biggest growth potential of any percentage. Now, it's an individual thing. We're going to go to the Vanguard website here. We're going to look at some examples of different portfolio allocations, and we'll take a look at how they've done. We don't have crystal balls. None of us do. I will tell you, we know there will be times when we lose money in the stock market. We have to accept that. It's that easy. So let's go and take a look at these different portfolios on the website, and we'll talk about them. We're looking at some Vanguard portfolio allocation models. So the first ones we see here are pretty bond heavy, pretty not something that we're going to do. Okay, so let's scroll down. Let's start with, there's a group of people out there subscribe to a theory that you should have bond minus your age or minus your age plus 10 to give you an idea of what you should have. So currently I'm about 60-40, but I'm 50 years old. So I guess I'm bonds age minus 10 rather in my bond allocation. So let's take a look at what that looks like as far as historical returns. The average return on a 60-40 was about 8.8%. Pretty good. So let's look at some more in the area we're going to be. So let's look at 100% stocks here. Let's say that you're a 25-year-old firefighter and you're starting out and you go, I'm going to go 100% stocks. The average return is 10.3%. Now that's average between 1926 and 2017, which is when they did this page. The best year ever was 33 again, and that's coming out of the Depression, right? 54.2. The worst year, 43.1% loss. So remember we talked about that $100,000 balance. Can you imagine losing $43,100 in 1 year? That would be hard. So let's say years with a loss. So 25 out of the 92 years that they looked at, there was a loss in the account. It happens. But the average return was 10.3%. Remember, we're doing long-term investments. So let's look at 80-20, which is about average for people up to, say, age 30 to 40, I would say. In this day, we have to be a little bit more aggressive because bonds aren't giving us much. So the average return here is 9.6%. Remember, the biggest loss you could take is half of the percentage you have in stock. So if you have 80%, you could take a 40% loss. Let's look at 70-30, which is a good mix for a lot of people. Even if they're a little risk averse, they have enough money that they can go back and forth if you have a downturn. So average annual return here, 9.3%. Pretty good. Best year, 41.1%. Worst year, 30.7%. You notice we're going down about 5% with each one of these and how much they've lost. Years with a loss here, 21 out of 92. So as you get more conservative, you have more years without a loss. But you also are not making as much money in the long run. So these are the kinds of things you have to think about when you make your asset allocation. All right. So let's talk about our investments in there we've been talking about. First of all, we'll just briefly take a look at cash, or what they call short-term reserves. This is money that you have in cash, usually in a money market fund. It doesn't make very much money. Average return over time, 3.5. Right now, you might get 2% in 2019. The problem is, after inflation, it really is losing money, guys. What about bond funds? We talked about bond funds, and this is going from the most conservative to the most risky, obviously. Bond and bond funds. The main flow is getting a moderate return in exchange for a moderate amount of risk. What does that mean? Bonds are less risky. The other thing is they tend to go in the opposite direction. When stocks are going down, bonds tend to do better, which means why one's part of your portfolio is going down, the other part can go up a little bit. Now, they don't make as much money, and it's right now, guys, it's about 2%. So it's really not going to be that much of a money maker. It's more your security so that you don't freak out when your stocks go down. Let's talk about stock and stock funds. Main goal of that is getting larger return in exchange for a larger amount of risk. We talked about that. The more you risk, the more you should be paid for your risk. Stocks can also be domestic or international. As with bonds, it's smart to consider holding both. So domestic stocks, that means U.S. stocks. Well, they're international stocks. Remember, the United States makes up about 38% of the world market in stocks. So if you only hold United States stocks, you're missing out on a lot of the stocks in the world. Now, how much you should have in your domestic versus international, that's a personal choice. I hold about 25% in international. The older I get, the less I want to take, because you do have other things. You have with international stocks, you have risk on whether the dollar goes up or down compared to the currency they use. There's some other things to think about there. Here's an example of how adding some bonds tends to lower your risk and sometimes your potential return. So when you're looking at it, 100% stocks, highest gain, 54%, biggest loss, 43%. We showed this before. Go up to 80-20, highest reward, 45.4, but we lost almost 35%. 70-30, 41% up, 30% down. So as you can see, the bonds tend to make it a little bit of a smoother ride for you. So this is something that's important when you decide what you want for your mix. If you guys are new to the channel and you like what you're seeing, you're getting some information, you're getting some free information on YouTube from a guy who just likes to talk about this stuff. Subscribe to the channel, give me a thumbs up for a like and all that, and we'll keep coming with you. All right.